Going back to Powell's pressers, and what he talks about is, he says every single time he gets up there, he reiterates and makes a point that, look, we cannot let inflation get out of control. We have to contain it. And we're telling you we're going to drive this economy into contraction, a recession, right? And so when they do that, they know, and he has said that they have tools to deal with that problem, right? But they don't have tools to deal with hyperinflation. So they're boxed into a corner, and what they'll do is they will drive this economy into a recession, and then they'll come back out with QE. And that's the QE infinity that everybody talks about.
Like many other macro analysts, former hedge fund manager and Bitcoin enthusiast James Lavish has been warning about some of the many economic pitfalls the United States has dug for itself over the past 2 decades. Lavish, who currently serves as a managing partner at the Bitcoin Opportunity Fund, says the Federal Reserve has made a complete mess of the United States economy, not only as a result of its constant money printing since 2008, but also by keeping rates artificially low for years, only to jerk it up at the fastest pace in history last year. According to Lavish, the United States economy is deeply embedded in a debt spiral, and the only way forward is to keep printing money to somehow keep the economy afloat. But this is as unsustainable as a person getting more credit card loans to pay off previous loans, and policymakers recognize just how dire the situation is. In one of his tweets from March, Lavish presented an interesting analysis of a recent report from the Congressional Budget Office, CBO. In its report, the CBO presented its federal budget analysis projections for the next 10 years. Here are some of Lavish's tweets from the thread. Taking a peek at the budget predictions, we see that CBO expects the U.S. Treasury to take in about $4.89 trillion in 2023. This is then projected to increase by over $2 trillion to $7 trillion by 2033. That's an increase of about 47%. But let's not get too excited, because this is just half the picture. And a subtle little detail here is that the CBO assumes no recessions ever. It appears expenses are coming in a bit heavy. The expected 2023 mandatory expenses are $3.8 trillion, up quite a bit from what the CBO projected to be $3.6 trillion just last May. Net interest is also up from the predicted $442 billion and is now $640 billion in 2023. Looking forward 10 years, it appears the CBO expects that expenses are likely going to grow about 60% to about $10 trillion by 2033. That's a lot more than the expected rise in revenues of 47% in the next 10 years. The CBO expects us to lose more and more money annually in perpetuity. Something I've talked about extensively is called a debt spiral. According to the report and Lavish's analysis, even without accounting for recessions, the CBO projects a 47% increase in revenue and a 60% increase in expenses. So how do they make up the difference? By printing more dollars. Only it's not logical or sustainable to keep returning to the printers. Lavish recently appeared on the Barron network, where he discussed the effects of the unprecedented rate hikes, the debt spiral, and the impending resumption of quantitative easing. According to the former hedge fund manager, the printers are coming back on, only this time they have to remain on for much longer. Before we listen to the insightful discussion and detailed analysis of the current shape of the U.S. economy, please take a little time to like this video, subscribe to the channel, and turn on post notifications so you never miss any of our subsequent uploads. Thanks, and enjoy the video.
Issue here is that the Fed raised rates at a rocket pace, right? They raised rates from ZIRP, zero interest rate policy, which we'd had for a long time since the financial crisis, the great financial crisis, until now. And they raised them so rapidly on a percentage basis. They were down at 0.25%, and now they're up over 5%. And so we're not able to see the effects of that tightening yet on the economy. We're just now seeing things that are happening in the credit sphere that indicate that that tightening is going to have a major impact to the economy. And that's what we're seeing in the regional banks. And for a number of reasons, that math is the math. It's not going to change. And that's why I wrote about this. We are in a debt spiral, Paul. There's no way out. We've gotten to the point where our deficit is expanding every single year, faster than our GDP, right? So, and the problem is we can't make that up. It's like if you're a single parent, this is what I tell people. If you're a single parent and you've got credit card debt and you're just trying to pay it off, but you can't really get there. You've got 2 jobs, you've got kids, you've got to pay for your mandatory expenses. which is your house, your mortgage or rent, your car payment, so you can get
Right.
back and forth to work, gas, food. You can't change those. And so you take out another credit card to pay off the last one, or to just have access to capital. And we keep doing that. And so, as you know, and I've seen you talk about this with other guests, is that right now, and even since I posted that, we've seen the first half numbers from 2023, and we're at such a large deficit that we're having to borrow more every single month in order to make up that deficit. So the answer is there is no way out except one way, which is massive money printing, massive inflation. That's the only way out. The issue is that it's just growing so rapidly, right? So what are the three things you can do as a government? And we're right up against the debt ceiling again, right? So we're going through this whole process again, and it's a big show. It's all theater, but you can have austerity, right? Which we've seen in Greece and Spain and Italy and back in the great financial crisis. That's one thing. You can cut expenses. Well, that's political suicide, right? To cut entitlements, to cut Social Security, to cut Medicaid. That's not going to happen. So that's one thing. The second thing you could do is raise taxes. But when you raise taxes, then you disincentivize productivity, right? And so you disincentivize, and you actually take money away from companies that they would otherwise use for reinvestment into their products, their services, right? To expand their footprint. And so in essence, in the end, it winds up having the same effect, where if you raise taxes, you shrink GDP ultimately. So that's the second thing you can do. The third thing you could do is you could print more bonds, right? Which is what we do to close that gap. But then when you do that, which is what you're getting at, is how long can you kick that can down the road?
Right.
Well, you need higher inflation in order to have a negative real rate of return. So what I mean by that is that you need GDP to grow at a faster rate nominally, right, than the interest on your debt. Okay, so that means you need GDP or inflation to be higher than the interest on the debt, which means that you have a negative real rate of return, right? So that's what they're looking to do. Now, the question is, how bad does inflation get? We keep hearing Powell talk about it on every single press conference, every single presser he has. He says we need to get inflation back to 2%. Well, that's an optic for the Fed, right? They want us to believe that inflation is down around 2%. It hasn't been. We can see it in our goods and services that we buy every day. That you go out to the grocery store, it is absolutely 20% higher than it was last year. Yet they're saying that inflation was 5% or 4.9%. It's not real. They move those numbers around.
According to Lavish, 4 options are open to the Treasury: cut expenses, raise taxes, default on its debt obligations, or print more money to buy its own debt. Of course, the first 3 options will never be considered, at least not this early on in the crisis. Policymakers and politicians will continue to assure the populace that everything, as well as the U.S. economy, remains as strong as ever. But those who can dig deeper will discover the Treasury's financial report titled "An Unsustainable Fiscal Path." During his interview with Paul, Lavish predicts that as early as 2025, we could really see things begin to unravel fast with the U.S. economy. He also discusses the BRICS alliance's de-dollarization agenda and what it means for the U.S. and the dollar.
But what they need to do is have that inflation higher. So how do they do that? Well, with that debt so great and that debt service so great, that number, they're eventually going to have to step in and print money. And going back to Powell's pressers and what he talks about is he says every single time he gets up there, he reiterates and makes a point that, look, we cannot let inflation get out of control. We have to contain it. And we're telling you we're going to drive this economy into contraction, a recession, right? And so when they do that, they know, and he has said that they have tools to deal with that problem, right? But they don't have tools to deal with hyperinflation. So they're boxed into a corner, and what they'll do is they will drive this economy into a recession, and then they'll come back out with QE. And that's the QE infinity that everybody talks about, right? And so to answer your original question, when does this happen? I believe this happens in the next 2 years. Within this cycle, we start to see a major breakdown in the economy where the Fed has to step in and do multiples of QE than they did even last time, which was massive. And so that's where the inflation comes roaring back in. And I don't know if it's 10%, 15%, 20%, but it is not going to be 4% inflation for the foreseeable future. It's going to be much higher. It's all interconnected, right? So we're seeing BRICS nations, Brazil, Russia, India, China, South Africa, they're trying to pull away from that dollar hegemony, right? So they have said they need to pull away from the stranglehold that the U.S. Treasury basically has on the world. If you want to deal in energy since 1971, you've literally had to do it with U.S. dollars, which means that you need U.S. treasuries in your own treasury as reserves in order to use those to have access to dollars to buy your energy. But they want to move away from that for a lot of reasons. One of them is that we demonstrated to the world that if you're on the fringe, if you're not one of our allies, we could just turn off your treasuries and you won't have access to them. We did that to Russia. That was a mistake in my mind, in my opinion. However, so what happens is, as they're trying to pull away, the thing is, Paul, the BRICS nations, as much as they want to have their own reserve currency, there's nothing there that can yet rival the treasury. If you look at the US dollar, and it has been going down in usage over the last 10, 12 years, it's gone from 69 or 70% down to 59%, but there's nothing even close to the US dollar. And that's really the most important thing here. The US dollar, I don't believe will lose the global reserve currency status. But I do believe, getting to your point, that we will see the rise of additional global reserve currency or global reserve assets. And particularly the one that I see that wins out is Bitcoin. Ultimately, between now and then, I believe that the BRICS nations will lean on gold as a reserve asset that they can somehow have audits to, that they can somehow deliver to each other in these massive transactions of energy. And that's really what they're getting at. And does that hurt the US Treasury? Absolutely. It crowds out that marginal buyer, those balance sheets, right? So we're already seeing these major nations pull back of their buying of the treasuries, right? So if you crowd out other balance sheets and you have to issue so many treasuries to deal with this massive deficit, well, who's going to buy those? The US Fed is going to have to buy them. The Treasury is going to print money at the Fed. The Fed will have the major banks buy them, and then they'll buy it from them, and they'll monetize the debt just like they did back in 2020. It is the same game plan, except it's going to be much larger. That's where the inflation really comes in, and that's where the problem with the Treasury comes in.
In his tweets, James Lavish provides some simple suggestions for those looking to protect their investments. He states that each person must consider their age, risk tolerance, liquidity, and earnings before making any big decisions. But here's what the macro analyst is doing. Here are some more tweets. Today, I hold a large percentage of my portfolio in cash as I believe there is a high probability that we enter a recession and the market sells off. I'm waiting for public market opportunities to present themselves. I'm also holding a larger than typical percentage of my portfolio in precious metals, mostly gold and silver. I'm also holding and buying Bitcoin opportunistically. I expect more volatility and entry points for all hard monies throughout these next few months. What are your thoughts on James Lavish's interview and his outlook on the United States economy? Are you doing anything differently to prepare for the coming storm? Please drop your comments and observations in the comments section below. Also, be sure you like this video, subscribe to the channel, and turn on post notifications so you never miss any of our regular uploads. Thanks for watching.